Hi, and welcome to Jankin's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to have a look at the bottom-up approach to quantifying exposures, which is an essential piece of information in a risk management process and a core skill of any risk manager. And we're going to use the occasion to clarify the relation between exposures and sensitivities. So for more extensive discussions about quantifying exposures, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Lars Oxelheim and Alf Helviniussen. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, so what we're looking for here is an understanding of what are our exposures to various risk factors. I mean, a risk factor, there have many risks that affect corporate performance, right? And we would like to get a grip on the extent to which they do so, right? So, and by extension, then we would like to get information on the sensitivity of performance to changes in this risk factor, which is an indication then of the response, the way corporate performance responds to a change in these risk factors. So this, you might say, is a kind of a precondition for managing risk. It gets very hard to implement risk management strategies that are effective at mitigating risk if you're sort of fumbling in the dark with respect to the magnitude of your exposures, right? So we need to get that in place first and then devise strategies for dealing with risk. So that would be the our perspective here. So just to clarify also what we mean by risk factors here. Well, it's something that is uncertain, you know, stochastic here in the terminology, and it also operates on corporate performance, so that when this variable changes, there's going to be an effect on corporate performance. And we're also adding in a material way to focus on the risks that matter. I mean, obviously there's a zillion different uncertain variables of, relatively minor importance that in one way or other affect corporate performance. But that's not where we're going to have our focus, right? We are talking about the risks that matter. So something uncertain, like an exchange rate, that fluctuates and changes day to day. And for many firms, those kinds of risk factors drive performance. Exchange rate, you have to translate your performance in foreign currency, and any receivables or payables you have in foreign currency, you have to transact, in the market. So they are going to impact your performance, and in many firms they do so in a material way. So the bottom-up method then, which is on the agenda here in this video, well, it's a very straightforward thing. So you're going to have some measure of performance here on the left-hand side. Then you have a specification of the components that make up that performance measure. So in this case, we have revenue over here, and this denotes home currency. So we're looking at performance as it would present itself to us in our home currency, probably as part of a budgeting process or some kind of forecasting exercise. And we have three risk factors then in this equation. First being quantity here, meaning how many units are you expecting to sell of this product or service. And then there's a price in foreign currency then. FC denotes foreign currency, so indicating a need to translate or transact in that currency. And then over here we have the exchange rate. So at this point we're talking about foreign currency denominated business activities, right? So with the need to convert that back into home currency. So it's a mathematical relation. It accounts for the totality here of revenue, like whatever you sell, the average price you're getting for each of these products, and then you convert that to home currency. So that would add up to your revenue. And we just model that as opposed to just having an overall number in home currency term already, just a given number in home currency. That is not sufficient here. We need to break it down into these components. So if we then take an example here, we're now talking a US-based company looking at some revenue. I mean, they may have exports to the Eurozone or some subsidiary active in that area. So the price is understood as, denominated in euros. So if you put some numbers on these things, you for example, a quantity of 100, average price of 25 in euros, and they manage to get an exchange rate or believe they're going to get an exchange rate of about 1.2, well, then we just feed those numbers into the formula, right? It's a simple matter of multiplying them up, and that will give you your revenue forecast. So, and something very similar goes on the cost side. Again, note that we're ultimately looking for home currency numbers here. Here we have something new introduced, which is the variable cost in foreign currency. We also have, which is then multiplied by quantity. And over here you have fixed cost in foreign currency. Again, multiplied by the exchange rate to get that back into home currency. So in a similar fashion, we can feed some numbers into the formula. So again, we take the perspective of the US-based firm over here. And same number as before for quantity. The cost per unit produced here is 10, sorry. And you have a 500 fixed cost, related to selling expenses, administrative expenses, all that sort of thing, and same exchange rates being forecasted. So plug those numbers into the formula and you have your cost estimate in home currency terms. So it's very straightforward, and once you have the numbers, it's simple. You just execute these very, very simple formulas, right? So if you put them together, now this looks a little bit terrible, but it's not that bad. I mean, these are very simple relationships, and anyone can set them up in a spreadsheet or so. And but the key here is that if we're talking exchange rate exposure, if that's what we're after for the time being, well, there are three places in this cash flow equation where foreign currencies appear. I mean, we're talking cash flow here, which is revenue net of costs. So we're just putting together the two equations in the previous slides, right? So then it looks something like this, where you have the revenue equation here, and this is your cost equation, right? And you have three components in there with exposure to the exchange rate. So what if we just rearrange that a little bit to clean up this expression? Well, then, we have all the foreign currency exposed components over here rounded up, so we can start thinking about them in net terms, because that's one of the goals here, to be able to net things and consider exposures, on revenue items net of cost items and vice versa, so that ultimately we work with net exposures. So feeding the same numbers into here, except the exchange rate now, we have an expression here that kind of informs us about our exposure to the exchange rate. We have this rearranging of the formula here gave us an expression for the exposure, essentially. So now the only uncertain factor here is the exchange rate. We haven't specified that for the moment, but just executing this gives you a number of 1,000. So that would indicate essentially your exposure then, and to arrive at your cash flow in home currency terms, well, just multiply that number with the exchange rate. So we're talking net numbers now in foreign currency. So that number would be, we would think of that as the exposure. That's the number of foreign currency units that we have. for that currency. I mean, we do this many times for each currency that we're exposed to. We're going to have to do something like this. So we're talking about net cash flow in foreign currency. We have successfully netted the exposures here from revenues in foreign currency, nets of costs in foreign currencies. So that's the net cash flow number then in foreign currency. And from a home currency perspective, that gives us the exposure, because now the only remaining factor to make an assumption about is the exchange rate. And the bottom-up approach has this feature built into it that the exposure to the exchange rate in this case is given by the two other components. So we arrived at the number by taking quantity times price, essentially. So that gave us the exposure, net cash flow in foreign currency. You can do a similar thing. I mean, risk, the prices could be viewed as a risk factor as well. You don't know for sure what the average price you realize is going to be. So it's a risk factor. And if you want to know your exposure to that risk factor, well, then you have to apply the same logic again. But in this case, it's the exchange rate times the quantity that gives us the magnitude that is exposed to the price. So whenever you change your price assumption, the way your model response will be given or determined by these two, the product of these two. And same thing here for quantity, which is also in many cases a highly uncertain number. So you want to try to understand what happens to your model when we change that assumption, or when something turns out to be different than the base forecast. Well, take the product of these two, price times exchange rate, and then you will have your exposure to that variable, to quantity. So generally speaking, then the exposure in the bottom-up equation is given by the product of the other two. So it's a very simple thing to remember here, that once you have your basic sort of performance model, the exposure is implied. It sort of follows from that, right? So, and it gets even simpler if you're talking domestic currency forecasting already, because then the exchange rate drops out and you're left with the quantity as your exposure to the average product price here. And your exposure to quantity will be given by a price. So that's quite straightforward, actually. And what is a sensitivity then? I mean, we've alluded to that a number of times already, but let's formalize it a little bit. It's a magnitude that determines the sensitivity. An exposure is a magnitude that determines the sensitivity of corporate performance to changes in risk factors. And that may be perhaps a bit of a letdown, this way of expressing it, because it seems circular, that it's a magnitude that determines the sensitivity of corporate performance. But that's how we should think about it, I believe, that we're ultimately interested in sensitivities, how the corporate performance changes as a result of different scenarios taking place or something like that. So that, and the exposure is what determines that sensitivity, the response of corporate performance to changes in risk factor. And that would be the numbers we just looked at. We have all the components. So what remains to be done is essentially assuming what kind of, or the size of the change in the risk factor has to be specified. So this is a choice we have to make, and we can go for a unit change, like if we're talking the oil price, well, 1 unit change is a $1 change in the oil price. And you could express your sensitivity that way, like what's the revenue change from a 1 unit change in the dollar, a $1 change in the price of oil. Or you go for one of these percentage numbers. And particularly 10% is a popular one in practice, because it is of some economic relevance. 10% is a respectable number that if something like that were to happen, it would be felt. Like it's not an irrelevant change in a risk factor. So the advantage of these percentage numbers is that they standardize the sensitivity and make numbers more comparable across different kinds of risk factors. Whereas a 1 unit change could have a completely different meaning. You know, if you compare a currency with the oil price, I mean, a 1 unit change is of a completely different order of magnitudes. So it's not meaningful to compare. So, all right, so we have that the sensitivity is about quantifying the change in performance from a change in a risk factor. And we have to define that change. But let's say then that we go for a 10% change and that we're looking at the euro US dollar, which is part of our cash flow equation here that we introduced earlier. So a 10% increase, if we start there, that means if our forecast is 1.2, the new assumption, you know, after the increase would be 1.32. That's simply multiplying it up by 1.1, right? So the sensitivity of corporate performance here to a change in this risk factor, the euro US dollar exchange rate, for a 10% change in that risk factor, it's going to be obtained as follows if we use the numbers that we got previously. So we have the net cash flow exposure here times the difference between the baseline assumption and the 10% change exchange rate. And that gives us a 120 sensitivity. So if the exchange rate were to go from 1.2 to 1.32, we can expect this change in corporate performance. So we have a general conclusion here, which is that the sensitivity is given as exposure times the chosen change in the risk factor. All right. So this is this always holds. It follows from this equation that we're using here, and it essentially answers the following question: then how much does revenue in this case change if the US dollar versus the euro changes by 10%? Now we have the information we were looking for, you know, something to tell us what we can expect in terms of performance changes if the risk factor were to be something else other than the best estimate in a forecast. Of course, this kind of modeling is a match made in heaven here with Excel, because it's like Excel is like made for this kind of stuff, and you set your spreadsheet up along these lines. You know, it's write out the volumes and the price expectations and exchange rates assumptions, and everything will tend to follow from that. You know, as long as you break it down into these components. So you feed that into a part of your spreadsheet, and from that you can obtain your forecast by multiplying them up. First here in euro terms, then by adding the exchange rate assumption here. And you can also use the same numbers here to derive exposure estimates. As you recall how we multiply or get the exposure to Q, for example, by multiplying by the other two. So it's perfectly possible to just set that up in Excel and have an overview of this. And it also follows that, you know, the sensitivities from this. You can derive them perfectly from based on this information. So given that it's determined by the exposure times the change, and we have opted for a 10% change, well, just round up your exposure here and define a 10% change here relative to the initial forecast, right? And you can multiply or get your sensitivity very easily. So now we don't have to be surprised, you know, by certain effects that you know happen later. We can anticipate them, and all it takes is that we set this up in Excel, you know, as indicated by the formulas. So here, let's say then that what actually happens later is in fact that the exchange rate turns out to be 1.32. You know, there is a 10% change. Well, then the revenue in euro terms will not be impacted by that. That's, you know, it's still in foreign currency terms, but the home currency value of those cash flows will be different now. So by multiplying with this exchange rate instead, so we get 3,300, which is 300 more than the previously obtained revenue, right? So the sensitivity was correct. So that's it's just how you can verify that your calculations are going the right way. So, well, it's very neat, very transparent, intuitive, right? We can see what's going on immediately, and nobody would protest to any of this. It's seemingly exact, and we all like that kind of precision. Unfortunately, and disappointingly, we're going to have to realize that in actual practice, it is much more problematic than this, and we're facing some serious problems when we're trying to get data for this of decent quality. And a lot of companies are finding it hard to rely on these numbers and have some degree of faith in them because of these issues, which have to do with the fact that they're so dynamic, that they impact each other. Like currency rates can drive volumes. So whenever you change the currency assumption, that has an effect on the volumes. So the components in the model are dynamic with respect to each other. There's also a massive complexity in organizations. So it can be hard to set it up like this, even though conceptually we know ultimately it would have to be something like this. But just getting there is, given the amazing complexity of corporate groups today, that operate on a global basis. So it gets difficult. And people tend to have inconsistent definitions of exposures, what it is we're supposed to come up with here. And when people are going in different directions with this, it's going to be hard to unify meaningfully in a corporate model, right? So we have that problem as well. So for these reasons, we're going to struggle a little bit to execute this, despite the intuitive and precise nature of these formulas. So, and we're also going to be considering an alternative to the bottom-up approach, which is the statistical method for quantifying exposures. But all of these things are discussed more in detail in other videos. We're going to conclude for now. And the bottom-up method essentially uses information on quantity, price, and exchange rates to quantify exposure. So if we're willing to break down our budget estimates that way and get somebody to come up with some forecasts for these components, then we can implement the bottom-up method. So, and based on these four exposures, the sensitivity of performance to changes in risk factors follows from that. I mean, it's implied by these structures, and we can start working with sensitivities of performance to risk factors as well, which is an essential component in a risk management process. And while seemingly exact and straightforward, it comes with several implementation difficulties that we just talked about, and we will have to explore that in other videos. So, but it's important to see that it's not as simple as it might appear. All right, that was that for this video. Please find more information in my books, Corporate Foreign Exchange Risk Management and Empower Risk Management. Also, riskbudgeting.se, you'll find more information there, and please like and subscribe. Have a good day.